Hello and welcome to today's video. In this episode, we will be discussing the Federal Reserve Bank's actions over the last year, what it will do next, and how this may impact gold prices. Before we begin, please make sure to hit the subscribe button and turn on the notification bell to stay up to date with our latest videos. The Federal Reserve Bank, or the Fed, is the central bank of the United States, and it has the responsibility of controlling the country's monetary policy. One of the key tools that the Fed uses to control the economy is interest rates. The Fed adjusts interest rates to achieve its dual mandate of maximum employment and stable prices. In March 2023, the Fed announced that it would increase interest rates by 25 basis points, or 0.25%. This was the fifth rate hike since March 2022, and it signaled the Fed's confidence in the strength of the U.S. economy. The decision to raise rates was driven by a robust labor market and rising inflationary pressures. Despite the recent rate hikes, the Fed has signaled that it is unlikely to increase interest rates further in the near term. In its March 2023 Federal Open Market Committee (FOMC) meeting, the Fed stated that it would maintain its current accommodative stance and that any future rate hikes would be gradual and dependent on the state of the economy. So, let's examine why the Fed is unlikely to increase interest rates further and how this decision may impact gold prices. Firstly, the Fed believes that the recent inflationary pressures are transitory and that they will subside as the supply chain issues and other pandemic-related disruptions are resolved. This belief is supported by recent data showing that inflationary pressures are starting to ease. Secondly, the Fed's decision to maintain its accommodative monetary policy is driven by its dual mandate of maximum employment and stable prices. Despite the recent rate hikes, the Fed remains committed to supporting the labor market and ensuring that inflation remains under control. Thirdly, the global economic landscape is still uncertain, with ongoing concerns about the Omicron variant and geopolitical tensions. These factors could lead to increased demand for safe haven assets like gold, even with the recent rate hikes. Now, let's move on to how this decision may impact gold prices. Gold is often seen as a hedge against inflation and economic uncertainty. When interest rates are low, investors tend to seek out alternative investments that offer higher returns, and this can lead to increased demand for gold. Additionally, low interest rates tend to weaken the US dollar, making gold relatively more attractive as an investment. Moreover, gold has historically performed well during times of economic uncertainty and geopolitical tension. The current global landscape is ripe with both. From the ongoing pandemic to rising tensions between the US and China, there are many factors that could drive investors to seek out safe haven assets like gold. For example, during the pandemic, many investors turned to gold as a safe haven asset. According to the World Gold Council, global gold-backed exchange-traded funds, ETFs, added 877 tons in 2020, which is the largest annual inflow on record. The inflow was driven by the uncertainty surrounding the pandemic and its impact on the global economy. Additionally, during the 2008 financial crisis, gold prices increased significantly as investors sought out safe haven assets. From the beginning of 2008 to the end of 2011, gold prices increased from around $800 per ounce to over $1,800 per ounce. Furthermore, the continued expansion of the Fed's balance sheet and the massive stimulus packages passed by governments around the world could lead to inflationary pressures and a weaker dollar. This would further support higher gold prices. In conclusion, the Federal Reserve Bank has increased interest rates through March 2023 but is unlikely to raise them further in the near term due to its dual mandate of maximum employment and stable prices, the belief that recent inflationary pressures are transitory, and ongoing uncertainty in the global economic landscape. This decision may impact gold prices as low interest rates tend to increase demand for alternative investments like gold, which is often seen as a hedge against inflation and economic uncertainty. Furthermore, historical evidence shows that gold has performed well during times of economic uncertainty and geopolitical tension, and the continued expansion of the Fed's balance sheet and stimulus packages passed by governments could further support higher gold prices. However, it's important to note that investing in gold carries risks and investors should carefully consider their investment objectives and risk tolerance before making any investment decisions. In addition, investors should also be aware that gold prices can be volatile and may fluctuate based on a variety of factors, including global economic conditions, geopolitical events, and changes in supply and demand. Thank you for watching today's video. We hope that you found it informative and helpful. If you have any questions or comments, please leave them down below, and we'll be happy to respond. Don't forget to hit the like button and share this video with your friends and family. And as always, please subscribe to our channel and turn on the notification bell to stay up to date with our latest videos.